So this is a quick video for the everyday person in Las Vegas or interested in Las Vegas. So it's an infographic I created for the Las Vegas housing market, and we're going to go over some price correction scenarios and catalysts. And this is for the month of May of 2025. But first, we're going to break down or take a look at just an easy way to contextualize the market, and one of the most important factors that I look at, which is the price to income ratios. So obviously, if you don't have the incomes to support prices, it's the high prices or the higher ratios are generally only sustainable for, let's say, a 2 to 3 year period before they have to come back down to reality. So we're just going to quickly go over the executive summary. So Las Vegas has experienced two major housing cycles over the past 30 years, with price to income ratios peaking at 6.53 in 2006 and 6.72 in 2002. Current ratios as of May 2025 remain elevated at 5.63, which is well above historic norms. Correction thresholds. So price correction historically begins when the price to income ratio exceeds 6.0, and you can read that further for yourself. Some of the key vulnerabilities: Las Vegas remains uniquely vulnerable to economic shocks due to tourism-dependent economy, or due to its tourism-dependent economy, high investor ownership, and increasingly challenging affordable metrics for local residents. And we'll take a closer look at some of those metrics. So this is for the last 30 years, so from 1995 until 2025. And as you can see, in the blue we have home price, in the green we have income, and then we have the price to income ratio. So the first time we had a big correction was when it peaked in 2006. So the average income was $49K, the average house price was $320K, and that ratio was over that 6.0 mark. So it was at 6.53, and so it hit 6.0 in 2005, and then by mid 2007 it had dipped under. So prices remained elevated for about 3 years or above that 6.0 level. So now let's take a closer look at the current market. So as we know, since COVID, prices have increased dramatically, and in 2021 the average home price was $390K, the average income was $64K, which gave us a price to income ratio of a little over 6. So we're in that zone again. And then it looks like we peaked out in 2022 at a price income ratio of 6.72. And now in 2025 we're back down to 5.63. But in a normal market we're going to be under 4. And so the neat thing about this infographic is that it's going to give us two different scenarios: a moderate correction scenario and a severe correction. So this is a projection from 2025 until 2030. So the purple line is the severe, and the moderate is represented by the orange line. So we'll just take a quick look. So let's take a look at 2027. So the baseline ratio is 5.2, which is still pretty high. Let's see here. And that would put the average home price at $395K. The projected income would be $76K. So that's in line with the moderate correction. If it was a severe correction, we'd be all the way back down to the 4.3 ratio, which is a little bit more normal. And so let's see. Let's go to 2029. 2029. Now we're within the 4.8 0.81 ratio, which is still fairly high. That's a baseline. If we had a moderate correction, we'd be around 4.5 price income ratio, and then with a severe correction, we'd be at a 3.2. So it's very interesting. So we're just going to quickly go over some of the correction scenarios, because you can't have a correction without a catalyst. So the catalyst, or the potential correction catalysts, are broken down into 3 different categories: the economic catalyst, the supply-demand catalyst, and the financial market catalyst. And we'll just go over a couple of these. So economic catalyst, recession. As they said, with tariffs, if they stayed in place, there's like a 60% chance of a recession. Obviously, Las Vegas is tourism dependent, so we get hit the hardest. But this is one of the most interesting economic catalysts I've seen, is the interest rate spike. So every 1% increase reduces purchasing power by 10%. So right now, interest rates are pretty steady, and there was just a Fed meeting 2 days ago that announced that. But just 1% will reduce purchasing power by 10%. Then mass layoffs, which I'm not sure how likely that is. Supply-demand catalyst, oversupply, population outflows. We actually have the opposite happening here. We don't have oversupply, and we have had massive population inflows for the last 5 or 10 years. The one that I think could be most likely is investor exodus, better ROI opportunities elsewhere, triggering mass selling. So maybe not mass selling, but interest rates are high enough where you can get 4 or 5%, in a money market account, or something that is considered risk-free. So if the margins are very slim on investment properties because of where prices are, why take on extra risk for a comparable return, or an extra 1 or 2% per year? And then we have the financial market catalyst. So commercial real estate collapse, credit tightening, and insurance crisis. I think the most likely one could be like a credit tightening. So if the market starts to pull back more, or we have any more uncertainty in the future, credit will start tightening even more, and that would affect commercial real estate prices. Okay, so the last portion of this are the probability of return to a 2.5 to 3.8 price to income ratio range, because that is what is considered a decent range for buyers, or a good range for buyers, and fairly normal. So it says over the short term, which is 1 to 2 years, there's about a 15% chance that we'll get to that ratio. So it will require, as we went over earlier, a severe economic shock or recession. Over the medium term, it's a 35% chance, 3 to 5 years. Over the long term, 5 to 10 years, there's a 50% chance. And so some of the key findings: Las Vegas housing has experienced extreme volatility, with price to income ratios ranging from 2.29 to 6.72 over the last 30 years. Housing bubbles have typically popped when price to income ratios exceed 6.0. Though current conditions remain elevated at 5.63, return to historical affordability levels, 2.5 to the 3.8 ratio, appears unlikely in the short term without a significant economic catalyst. As I mentioned before, we would need a catalyst for a correction. Number 4, home prices have grown at 5.5 annually, while income grew at only 2.4% annually, creating a widening affordability gap. And the last one, Las Vegas is a tourism dependent economy, and it makes it vulnerable to economic downturns and other correction catalysts. So this should come in at right under 10 minutes, which isn't too long. In the future, I'll make it a bit shorter, and this is just showing us the sources of all the data: Case-Shiller Home Price Index, Fred Data, the Census Bureau, and Zillow. Thanks for watching.